only mode.
Good evening, everyone. On behalf of HDFC Securities, I welcome you all for this session on futures and options, trade futures and options with HDFC Securities. So, firstly, let me introduce myself. My name is Tarang Solani, and I am the product manager for derivatives in HDFC Securities. And I will be the host for this session on futures and options. So, what we'll be covering in this session would be basics on futures and options, followed by we will also look onto various offerings which is provided by HDFC Securities for derivative for derivative traders. So, and post that we'll also share some views on the market, basically how it would be and what kind of an thing which we can expect. And after that, we'll take in question answer section. Whatever questions you will be having it, we'll try to address most of the questions in the question answer section. So without wasting any time, I will quickly start on this session. Futures and options is a very interesting concept. Basically, if you think if you would have if you would have understand about all the topics and if you would have traded before, you might have known that futures and options is a very vast concept to understand. It has many complexities in its own, and hence majority of the people do find it difficult to understand, and due to which what happens is basically they stay away from it and they don't participate in this instrument. So after this webinar, I'm sure you will be having lot of insights about futures and options, what exactly is futures and options, and how to trade in HDFC Securities. You need to have a derivative privilege to trade in futures and options. For that, you need to register for derivative privilege. It is a very short process. And post that, you can trade in futures and options. Once it is registered, all your documents are verified. It's an online process. You don't have to go offline. Suppose this webinar will just give you the link how to opt derivative privilege. If any of the clients doesn't have derivative privilege, they can opt for it and they can trade in futures and options in HDFC Securities. So I will request, since it's a very vast topic, so don't hesitate basically to understand this concept. It's a very new concept and very easy to understand also. So we'll request everyone to start think differently, because futures and options is a very good tool and there is a big opportunity at hand. So prepare for the opportunity at hand, because if you see in exchanges, there out of total volume which happens in NSE segment, apart from out of the total volume, around 90 to 95% of the volume comes from derivatives, that is from equity derivatives, which is a very huge number. Now, why this amount of volume which we have been getting it is because many participants are there into this market. They have been seeing lot of opportunity, and hence more and more people have been trading into it because money has been made, and hence we have been seeing lot of participants getting added day in day out throughout the span of time when FNO launched. So in the last slide, we also share the number of volumes which has been now happening in the NSE market in derivatives, which is quite remarkable compared to what was happening a few years back. So prepare for the opportunity for the hand and start thinking differently. Now, what is derivatives? We'll give an introduction of derivatives. So derivatives can be of anything, be it commodities, currencies, interest rate, stocks, or index. So any instruments which have an underlying asset means one which is traded in the cash market segment. They take reference, they take price reference from that, and can and based upon that they trade in futures and options market. Our main focus would be stocks and derivatives and index derivatives. Now, what are the popular derivative instruments? So under derivatives, there are 5 kind of derivative products. That is forwards, futures, options, warrants, and swaps. This all are called as a derivative instrument. But our main focus would be futures and options, because these are the both are been traded on the exchanges. The rest all are not traded on the exchanges. They are the over-the-counter products which are been tailor-made, tailor-made, I mean to say, which has been developed by the financial institutions only to sell to other financial institutions. And retail client cannot trade in this forwards, warrants, and swaps, but they can trade in futures and options, which is listed on the exchanges. And what are the participants? There are three participants. First are the hedgers. So who are hedgers? Hedgers are the one who basically trade into the market, creating an protection leg with it. So they don't enter into the market naked. They do have a protection leg with them. So they are protected if in case their view goes wrong. They have a protection leg so that they don't incur major loss. Arbitragers are the second participant in the derivatives market. They are the one who constantly looks for the mispricing. Wherever they find any kind of a mispricing between cash and futures or between futures and options, they come into picture and try to take benefit of that mispricing, and they trade in big quantity. And last and foremost are the traders. The traders are the one who basically, based on the fundamental or technical aspects, if they have a view on a particular stock or index, based upon that they take positions into derivatives market. They are known as the traders. Now let us understand the first derivative instrument, that is futures. Now first let us understand the features of the same. So all the derivative instrument, as I mentioned earlier, they have an underlying asset. The underlying asset are the one who are traded in the cash market segment. All the derivative instrument, being it futures or options, are standardized contract. That means they come with a specific lot size. Now, what do you mean by specific lot size? So if you want to trade in Nifty or Bank Nifty, you must be knowing there is a specific lot size. In that number only, you can take positions into the derivatives market. For Nifty, it is 50 shares, and for Bank Nifty, it is 25 shares. And same thing for every stock which are listed in derivatives market. So apart from index and including index and stocks, there are 200 index and stocks which are listed in, to be precise, 196 index and stocks which are listed in the derivatives market. They all are standardized in nature. That means they come with a specific lot size. That is, you cannot trade one shares. If you want to trade one shares of Nifty or Bank Nifty, you cannot trade. You need to compulsorily trade in a multiple of the lot size. For Bank Nifty, as I told, it is 25 shares. So in a multiple of 25 shares, you can trade into the Bank Nifty instrument. And same thing for Nifty, it is 50 shares. So in a multiple of 50 shares, you can trade in Nifty. So hence they are called a standardized contract. They come with an expiry date. So every derivative instrument comes with an expiry date. Now, what is expiry date? Is basically it is the last Thursday of every month. We have an expiry date for stock futures, stock options, and index futures. However, we also have a weekly expiry contracts for index options. For Nifty and Bank Nifty, it is last Thursday of every week. And Fin Nifty, there is one more index which is listed in derivatives named as Fin Nifty, which has an expiry on every Tuesday. So I'm talking about weekly expiry. So there are two types of expiry. One is weekly expiry contracts, which are available only for options, that is for index options only. And only Nifty, Bank Nifty, and Fin Nifty has a weekly options expiry. However, for rest other futures and options, that is for stock futures, stock options, and index futures, we have a monthly expiry contract which expires on last Thursday of every month. Then we have a contract cycle for futures. At a given point of time, there are three contracts which are available into the market for futures. So if you want to trade in futures, you can trade for any of the three contracts which are available, that is near month, next month, and far month. So for example, now the March expiry contract have already started. So at a given point of time, suppose you want to trade in Reliance future, you can trade in Reliance March future, you can trade in Reliance April future, and you can trade in Reliance May future. So either based upon your view, you can take position either of this contract. There is a contract cycle. So at a given point of time, there are three contracts which are available in futures market. One more features which is a very important feature is called as physical settlement. So for stock futures and stock in the money options, we have a concept called as physical settlement. What is physical settlement? I will make you understand in a brief. Physical settlement means you need to settle your positions if you don't square off any futures contract, that is stock futures contract or stock in the money options. before the expiry or on the expiry day, if you don't square off your position, then you compulsorily have to take a physical settlement and you need to oblige to whatever obligation has been received. Physical settlement means you need to either give delivery of the particular share you are holding, or you need to take delivery of that particular shares compulsory. So what exactly happens? Let us understand. So initially, what used to happen in the past when the physical settlement was not there? So what used to happen is at the time of the expiry, on the day of the expiry, suppose you don't square off your positions in futures or stock in the money options, then what used to happen is basically it used to be cash settled. Whatever profit and loss it used to debit or credit from your account. So it was very simple. You don't have to take any kind of stress to square off your position. But now, if you are trading in stock futures or stock in the money options, if you don't want to, if you don't want an obligation for physical settlement, make sure that you square off your position before the expiry date. Or else, if you don't square off, then it will go for a physical settlement, and physical settlement means either you need to give delivery of the particular amount of shares you are holding, or you need to take delivery of the particular shares you are holding. So here you need to be careful enough because if you don't oblige to physical settlement, and if the particular contracts go for a physical settlement, then there is a big penalty which exchange charges on you, especially on the case if you are obliged to give delivery of the shares, and if you don't oblige to that of giving delivery of the shares, then you might charge not only the penalty which the exchange charge, but also you will face an auction of your shares because since you don't have that particular amount of shares in your demat account, and exchange will do an auction on your behalf, and that auction usually takes place 5 to 20% higher than the current market price, and for that you get the delivery which is 20% higher at the current market price, and then you need to give it to the exchange back, and also you need to suffer the penalty. So make sure you, wherever you trade in futures and options, if you don't want to go for physical settlement, make sure that you square off your positions before expiry date, on or before expiry date. One more feature, if you don't want to square off your position, or if you want to hold on to your position, sorry, I will just change my, I will rephrase my word, that if you still want to hold on to your position, you can roll over your position to the next month. Now, what rollover means? Suppose you have Reliance future with you, and tomorrow is an expiry date, and you still want to hold Reliance future. So what you can do, you can square off your current month series, whatever you have, and you can take same position in the next series. That process is called as rollover, so that you have that positions with you, and you have squared off your current month series contract, so which is going to get expired tomorrow, and you have taken the new positions in the next month series, which has an expiration which is 1 month long. So you can roll over your position also, and that rollover happens only in futures. You cannot roll over your options contract, because options contract do get to zero if in case it doesn't if it doesn't expires in the money. So now let us understand the advantage of trading in futures. The first and foremost advantage are margin payment. You need to pay a very small amount of margin to enter into the position, and that is a very big USP for tradings in futures and options market. The capital requirement is very less. So let us understand in detail. Now, suppose you have a bullish view on Infosys. So there is two ways where you can participate in this. Either you can go long on Infosys through cash market segment, or you can go long in Infosys through derivatives market. Now we'll take an example for futures under derivatives. Now suppose you have a view, you take 300 shares, you have a positive view, you buy 300 shares of Infosys at 1500 rupees. Your total value of a position is 4,50,000 rupees. You have to pay full 100% to take a delivery of 300 shares of Infosys. However, the same thing if you buy it in futures, 300 shares at 1500 rupees, you don't have to pay full 4,50,000 to enter into the contract. You just have to pay 20% of the total value of the position, The total value of the position is 4,50,000 and 20% of 4,50,000 is 90,000. So by just paying 90,000, you can take an 300 shares. You can take buy position in Infosys of 300 shares at 1,500 rupees. So that is basically in very less capital, you can trade in big quantity. That is which we call as you can leverage yourself. You can get 5 times leverage basically so that you can trade in more number of quantity. Also, if you have enough capital of 4,50,000, you can buy 5 lots of Infosys, which comes to 1,500 shares. But with 4,50,000, if you buy it in cash market, you can buy only 300 shares. So here, in a very less investment, you can trade. You can take exposure of more quantity. That is, you can get more leverage in a small amount of investment. So approximately 4 to 5 times of leverage which you can get by trading in derivatives market. So for futures, this is the amount of margin is required. But if you trade in options, even the margin requirement or the capital requirement decreases significantly. So in a very small investment, you can trade in options. Once we start learning about options, you will come to understand how much margin will be required. In a few thousands of rupees, you can trade, you can take positions in options and take an exposure worth of whatever it is in futures market. So here, basically, futures and options market require less capital, and you can get a more leverage. So that was the first main advantage. Now we'll move to the mark-to-market margin. So in futures, suppose you take any kind of a position. Now take an example of the same example which we discussed on Infosys. Suppose you bought Infosys future by paying 90,000 as a margin. You bought 300 shares of Infosys. And after that, your work doesn't stop there. On a day-to-day basis, based on the fluctuation of Infosys price, your mark-to-market margin obligation will be calculated. If it's positive, if the Infosys price is in a moves in your favorable direction, then there is no obligation which will arise. But yeah, if it's negative, suppose you have bought Infosys future, and after that it comes down, then how much ever it comes down, you need to have a you need to pay that amount which is called as the mark-to-market margin on a day-to-day basis. Now, suppose you bought Infosys at 1,500 and tomorrow it falls to 1,400. There is will be 100 rupees into 300 shares which you have bought. That is 30,000 would be demanded by the exchanges. That will be an obligation to you which you need to meet. Which you need to meet. A failure to meet that will result in cut down of your positions. So there is a mark-to-market margin which is involved on a day-to-day basis. You need to fulfill this mark-to-market margin. One more advantage of trading in futures is short position is possible. You can take advantage of the negative view of the market. Yes, in this kind of a market scenario where there is a negative trend which is going on right now, you can also take advantage of the negative view by first selling whatever stock or index you have a negative view of. You can first sell, and then once the prices decreases, you can buy it back again. So here you don't have to basically complete this transaction in a intraday, irrespective of how many days you want to hold. You can hold on to it. It is not necessary that you need to square off your position on the same day. You can hold on this short position of the future. You can hold on for as many days as you want till the expiry date. So it's a very good instrument. Now, not only you can trade on the bullish view of the market, but also you can trade on a bearish view of the market. Then the stock which is listed in the derivatives market, they don't have any circuit limit. They can list, go n number of percentage higher or lower. And last and foremost advantage of trading derivatives is index trading is possible. That is, you can trade in Nifty, Bank Nifty, and Fin Nifty. Because trading in index requires less amount of capital, risk involved is also less, and it is also taking view on stock sometimes becomes difficult, but taking view on index sometimes becomes very easy. And so there's a three advantage of trading in index. First is capital requirement is less, risk is less, and taking view on index is easy. Hence, you can probability of going right becomes high. Now let us understand about the very interesting concept called as options. Now what are options? In a layman language, if you see option, there are two types of option, that is call option and put option. If you are bullish, if you want to take advantage on your bullish view, you need to buy call option to take advantage on your bullish view. If you are bearish, you need to take advantage of your bearish view. That is, if you feel that the particular stock or index will come down, if you want to take advantage of it, you can buy put option. So if the particular stock or index falls, the prices of the put option will rise, thereby benefiting you. Same way, you can take advantage of your bearish view by selling call option, and you can take advantage of bullish view by selling put option. Now let us understand with an example so that your concept becomes more clearer. So this is an example. Now suppose Nifty is at 17,500 and I have a positive view on the market. I feel that the market would go up. So in this scenario, what I will do is I will buy call option because my view is positive. Whenever your view is positive, to take advantage of your positive view, you need to buy call option. So if the market of the particular stock you have bought call option increases, prices of that increases, the price of the call option will also increase, benefiting you. So here I have a view that the Nifty will go up, hence I will buy call option. So I buy 18,000 call option at 150 rupees. Now 18,000 is called as the strike price. There are different strike price which are available into the market. Based upon your view, you can pick the strike price. So I bought 18,000 call option at 150 rupees. Now since I'm a buyer of an option, my risk is just limited to the premium I am paying it. So in this case, this 150 is called as the premium and 18,000 is called as the strike price. So I will be paying 150 rupees into 50 shares because 50 is the one lot of Nifty consists of 50 shares. So 150 rupees into 50, that is 7,500 is the total capital required to initiate buy position of 18,000 call option at 150 rupees. Now here my loss is restricted to the premium I have paid. So maximum loss I would be incurring if in case my view goes wrong and Nifty doesn't go below 18,000 level and expires below 18,000. Nifty doesn't go above 18,000 level and expires below 18,000 only. That means my view went wrong, and maximum loss for my for in this trade will be 7,500. That is 150 rupees per share and not more than that. But in case my view goes right, I tend to make unlimited profit because I'm a buyer of an option. So in a buyer of an option, the risk is limited to the premium is paid and the reward is unlimited. So here in this scenario, if Nifty expires at 18,400, I can make 250 rupees per share as a profit on an investment of 150 rupees per share. That means close to 2 times I can make the profit. So how 250? Difference between 18,000 and 18,400 is 400 points. And you have already paid 150 rupees. So net you will make 250 rupees if in case Nifty closes at 18,400. So this is how basically interesting these options is. Require very less capital, risk is also less to the premium paid, and reward is unlimited if in case your view goes right. Now another example of selling call options, as I told, if you have a bearish view, you can buy put option to take advantage of your bearish view, and also you can sell call option to take advantage of your bearish view. Now in this case, if you understand, you have a view that Nifty at any cost would not go above 18,200 level. So what you can do is you are basically, your view is that you are bearish above 18,200 level. So what you can do is you can sell one lot of Nifty 18,200 call option at 100 rupees. So this 18,200 is called as the strike price and 100 rupees is called as the premium. So here you are a seller of an option. So risk and reward functionality gets completely opposite of what exactly it would have been for buying of option. So selling of option, your risk is unlimited if your view goes wrong and Nifty starts move above 18,200 level. Hence your view went wrong and you into unlimited loss how much ever it goes above 18,200 levels. However, your profit, that is your reward, is just limited to the premium you are receiving it. In this case, whenever you sell the options, you have sold at 100 rupees. So that 100 rupees is the premium which you will be receiving it. And that is only your maximum profit. So here, if Nifty, if your view goes right, that is Nifty doesn't cross 18,200 level on the expiry, it closes below 18,200 level. Wherever it closes, it doesn't matter. You will get, if it closes below 18,200 level, you will get 100 rupees per share as a profit. And that is only your maximum profit to earn from this leg. But if in case if Nifty starts moving above 18,200 level and how much ever it goes above 18,200 level, the loss is unlimited. Now suppose Nifty expires at 18,450, you tend to make 150 rupees as a loss. How 150? So difference between 18,450 and 18,200 is 250 points. And you have already received 100 rupees while selling this 18,200 call option. So net you will be losing 150 rupees if in case Nifty expires at 18,450 against your view. So this was all about selling call option. Now let us understand about put option. What exactly is put option? As I made you understand in a layman language, if you have a bearish view on a particular stock or index, you need to buy put option to take advantage of the bearish view, because if the particular stock or index falls, the prices of the put option will increase, thereby it will benefit you. And same way you can use put option as an insurance policy also. So how? Let us understand. So put option. So first, let us take an example of insurance policy. So suppose you have a vehicle insurance with you, and against that, to buy that vehicle insurance, you pay premium to that vehicle insurance company to buy the insurance policy. Same thing, if you buy put option, you pay premium to buy that particular put option. Suppose you buy 17,000 put option, so that 17,000 is an insurance policy to you. You pay premium to that. Against that insurance policy which you have bought for vehicle, that insurance company will assure you that if anything happens to your vehicle, if it gets stolen or if it gets damaged, I will compensate. Same thing, if you buy 17,000 put option, that 17,000 put option will assure you that if in case market goes below, how much ever it goes below 17,000 levels, I will compensate you. So put option is treated as an insurance policy only. Basically, if you have a long portfolio or big holdings in MTF or E-margin, then you can safeguard your positions by buying put option. So suppose if your view goes wrong, you don't tend to lose much in that, because if you have bought put option on the lower side, that put option will make money for you. So net your loss will get restricted. And same thing, if in case if it goes higher, you already have that position in your portfolio or MTF, that will help you to gain maximum returns. So this is how you can use put option. That means the put option is not only for the traders, but also it is there for the investors. So now here I have a view that Nifty will fall. So what I do is I buy one lot of 17,000 put option at 80 rupees. So I am a buyer of an option. As I told, once you are a buyer of an option, your risk is limited to the premium paid, that is in this case 80 rupees, and your reward is unlimited if in case your view goes right. Here I have a view that Nifty will fall below 17,000 level. So how much ever it goes below 17,000 level, I will make profit from it. So I have bought one lot of Nifty, that means 50 shares at 80 rupees. So net my investment is 4,000 rupees. And 4,000 rupees you can buy 17,000 put options, such as low investment, and your risk is also limited to that 4,000 rupees only if in case your view goes wrong, but your reward is unlimited. How much ever it goes below 17,000 level, that how much ever it goes, it benefits you. So suppose Nifty closes at 16,600, so in this case you can make 320 rupees as a profit. This is 320 rupees as a profit on an investment of 80 rupees. That is 4 times you can make money. How 320? Difference between 16,600 and 17,000 is 500 points, and you have already paid 80 rupees. So net you will be making sorry, difference between 17,000 and 16,600 is 400 points, and you have already paid 80 rupees. That means net you will be making 320 rupees as a profit if Nifty expires at 16,600 levels. So approximately 4 times the returns you can make on your investment. By just paying 4,000 rupees, you can make 16,000 rupees as a profit if you hold on to your position till expiry, and Nifty expires at 16,600 level, then you tend to make 320 rupees per share as a profit. If you multiply it by one lot, that is 50 shares, then it comes to around 16,000 rupees as a profit on an investment of rupees only 4,000 rupees. So this is the beauty of the options. Basically, you require very less investment. Your risk is also limited to the premium paid, and your reward is unlimited if in case your view goes right. Now here, as I made you understand in my option slide, that if you are bullish, you can also either buy call option or you can sell put option. So here I have a view that Nifty won't break below, won't go below 16,800 levels for this expiry. So what I do, I sell 16,800 put option at 50 rupees. Here I have a view, I have a positive view above 16,800 levels that Nifty would expire above 16,800 only. So I sell 16,800 put option at 50 rupees. Now, since I am a seller of an option, your margin requirement will also be high. To sell this 16,800 put option would require approximately 80,000 rupees of margin. However, your risk is unlimited if in case the view goes wrong, and hence the exchange also would demand higher capital. Hence, you are paying more margin of around 80,000 rupees to sell 16,800 put option. Here, my maximum risk is unlimited if in case Nifty starts moving below 16,800 level. However, maximum profit is just limited to the premium I have received. In this case, 50 rupees per share is my premium I have received, and that is only my maximum profit. So only 2,500 rupees I will make if in case Nifty closes on or above 16,800 level. How 2,500? Because 50 is the shares consist of one lot for Nifty, and 50 rupees is the premium I have sold the 16,800 put option. So here you will ask why people will block so much amount of capital to gain only 2,005 rupees as a profit if in case a view goes right. So selling of options is like a probability game. If you have a probability that Nifty 99.99% would not go below 16,800 levels, then there is 99.99% probability to earn full 50 rupees as a profit if your view goes right. So hence, more and more people also try to play based upon the probability, how much is the probability of winning and loses. Based upon that, they create the position into the exchanges. However, there is an evidence that people who basically trade in options, only of selling of options, they tend to make more money compared to people who trade only in buying of options. So there is one study that could be wrong also, but what we have basically understood from it, that selling of options, however, it requires more capital, but also your probability of earning profit is also high compared to buying of options. Now let us understand about different option terminologies. Once you start trading in options, you will come across various terminologies of options. Let us go and understand it in detail. Now, first terminology is the spot price and the strike price. Now, what exactly it is? So here, this is a snapshot of our option chain of Pro Terminal, which is our advanced trading portal. So here you will be able to see on a vertical line, there is a strike price, which is there. For every 50 rupees interval, you will check there is a strike price, which is available for Nifty. And this strike price has been decided by the exchanges. We and you don't decide the strike price at how much interval and how much strike price would be available into the market. And if you see, this is the strike price, and on the above the strike price, there is an future and cash market price. So underlying future price of a same instrument, and the cash market side, there is a spot market price of the same instrument. So you can check that also on the uppermost table. Now let us understand three more concepts, that is in the money, at the money, and out of the money. Now what is in the money, at the money, and out of the money? Now here you need to be very careful to understand this, because at the time of the expiry, if you only in the money stock options go for a physical settlement. So for that you need to understand what is in the money to identify that particular options which you are holding, it will go for a physical settlement or not. So for that you need to come to know that if the particular options I am holding is in the money, at the money, or out of the money. So let us understand with this chart only. So here, if I make you understand on a layman language, whatever shaded part on the left, this is the option chain. I have already discussed about it. These are the strike price, and on the left hand side you will see all the call related detail, like price of the particular strike price of the call, what is the change in the price, what is the open interest, what is the change in open interest, what is implied volatility, what is volume. So here it is a snapshot of that particular option chain which we have in our advanced trading portal called as Pro Terminal. On the left hand side you will see all the call related detail, and on the right hand side you will be able to see all the put related detail. So here, if you want to check which options are in the money, at the money, and out of the money option, so very simple to check. Whatever options lies in this shaded part will come into out of the money options for call side, and for put side, this shaded part is over here, and it is called as the out of the money options for the put. Sorry, whatever the shaded part it is called as in money options. I'm very sorry. So whatever the shaded part, you will be able to see they are the in the money options. On the left hand side, if you see call side, whatever the shaded part are from 17,550 to 17,900, they are all in the money options. And same thing get reversed for the put side, 17,950 to 18,250. If you check, they are all the shaded part, and they are called as the in the money options. So if your strike price belongs to this shaded part, that means it will go for a physical settlement. And if you don't want to go oblige for a physical settlement, make sure you square off your positions on or before the expiry date. And apart from this, the unshaded part are all called as out of the money options. The left hand side, if you see the unshaded part are from 17,950 to 18,250. And the opposite of that on the put side, from 17,900 to 17,550 are all unshaded part, and hence they are the out of the money options. And any strike price which is closer to current market price, that is 17,900 or 950, I would say 17,950, which is closer to current market price, are the at the money options. So this was all about in the money, at the money, and out of the money options. Now we'll understand two more concepts called as intrinsic value and time value. Now, as I told, options is a bit complex. So there is always a different premium involved in it for different strike price. If you check 17,550 call option premium is quoting at 410 rupees. 17,900 call option is quoting at 126 rupees. 18,100 call option is quoting at 40 rupees. So you will be confused basically what are strike price and what are the premiums which is currently going on, and why the premium it is on some strike price the premiums are high, and for some strike price the premium are low. So for that you need to first understand what is intrinsic value and time value. So intrinsic value and time value basically helps us to identify what is the exact value of the options which you are buying or selling at the current market price. So here, suppose you buy 17,700 call option at 274 rupees. Here it is 17,700 call option, quoting at 274 rupees. So how will you identify how much is intrinsic value and how much is time value? Because as I made you understand, only the shaded part, which is also called as the in the money, they would only have an intrinsic value. Unshaded part would not have an intrinsic value. They would only have a time value. So suppose you have bought 17,700 call option at 274, then you need to identify how much is in the money or at the money. So let us understand, you need to deduct from the current market price 17,700 minus 17,000, suppose round it at 17,900. So 17,700 minus 17,900 is 300 points. Sorry, so 200 points. So here 200 points is then in the money, that is called as the intrinsic value, and over and above 200 points of 274 premium which is quoting at, that is 74 rupees, is the time value. So 200 is the intrinsic value and 74 rupees is the time value. Now time value is like a time bomb. Basically how much ever it comes closest to expiry, the time value starts reducing quickly, and it slowly and steadily on the expiry date time value will become zero. Only the intrinsic value will remain in a particular option strike price. If there is any intrinsic value, only that price or that premium will only remain. Time value will become zero, and that would be basically from the premium, time value will go out and only intrinsic value will remain. And hence it is very much necessary to understand if you're buying any kind of an options, you need to understand how much is intrinsic value and how much is time value, so that you come to know, if I hold on to the expiry, if the market closes at the same level, then this is the amount of premium which would be there on the expiry date. And last is the maturity and the expiry date, which is, as I made you understand, we have two types of option, that is weekly and monthly options. For monthly options, we have last Thursday of every month as an expiry, which is there for stock futures, stock options, and index futures. And only for index options, that is for Nifty, Bank Nifty, and Fin Nifty, we have a weekly expiry instrument, which expires for Nifty and Bank Nifty is last Thursday of every week, and for Fin Nifty, it is on every Tuesday. So here, let us now see benefits of options. What are the benefits of trading in options compared to equities? Now, if you see right now this kind of a volatile scenario, if you would have bought any kind of an equity portfolio, equity holdings with you, volatility is so high based upon the global news and domestic news, which are quite unpredictable. In trading, you can exit would become difficult for you. There is high probability that you can your stop loss could have triggered, and for investors it could be a massive erosion in portfolio. But if you are traders in options, as I made you understand, you can not only trade on a bullish view, also you can trade on your bearish view. That is, if you have a negative view, you can buy put option, and if the market falls, you can make money from it. So you can trade in both the direction of the market, and there are different strategies which is there, which we can trade on if you have a range bound view or a volatile view. So in each and every market conditions, options has something to offer for you. It comes with a predefined loss. So suppose if you are a buyer of an option, it comes with a predefined loss. You know how much is my maximum loss. If I am a buyer of an option, your capital which you have blocked is only your maximum loss, and it comes with a specific time frame, and you know till expiry only I have to hold on to this position, so you know when to exit. And as it comes with a specific time frame, you are aware of the validity date of the contract. It can also be very useful for a portfolio protection strategies, like as I made you understand, by buying put option, you can ensure your portfolio and also big MTF positions. So this options will also help you to protect your portfolio by doing various portfolio protection strategies, and also could have and generate income by selling call option. So here you can options is a tool where you can trade in multiple directions of the market. It's a tool where you can basically help yourself in ensuring against some of your portfolio holdings or all of your portfolio, and also helps them to generate income by selling call options. So here, this is the perspective on how volumes have shifted. As I made you understand in my first slide, that volumes have been considerably increasing in derivatives market. Why? Because more and more participants are entering into this system, and they are finding it very useful. And also there has been they are finding it a lot of opportunity there is there to trade in derivatives market. So if you check from the last 8 years, the volumes in FNO have gone up 25 times. That is, on a daily basis, it used to happen 2.29 lakh crore per day in 2014-15, which is now happening around 59 to 60 lakh crore in a single day in 2021-22. So this is the amount of jump in the volume which we have been seeing, especially in index options. This yellow bar is the volume of the index options, that is Nifty, Bank Nifty, or Fin Nifty. So we have seen an exponential jump in the turnover which is happening in index options, because as I made you understand, index options quite economical to trade. If you are starting your journey in derivative trading, you should start your journey through index options only, because you will help it will help you to basically since the investment requirement is also low, the risk involved is also low, so it will help you to gain confidence of to trade in futures and options market through index. And once you gain confidence, you can then trade in stock futures or stock options for further trading journey of into derivatives market. So now let us understand about HDFC Securities offerings, what HDFC Securities has to offer you in derivatives market. So HDFC Securities provides you rupees 20 per order in futures and options brokerage. And if you don't have this brokerage of rupees 20 per order, you can subscribe to our derivative value plan, which is worth of 199 plus tax. It's an annual charges. By just paying 200 rupees, you will get rupees 20 per order brokerage in FNO, which is an annual charge of 200 rupees. and simultaneously you will also get free access to Pro Terminal, which is our advanced trading portal. Now, Pro Terminal is basically if you just if you just buy only Pro Terminal, subscribe for it, it is charged around 1,999. But if you buy derivative value plan, you can get rupees 20 per order brokerage in FNO and also free access to Pro Terminal, which is our advanced trading portal. So post this session, we'll also give you the link of how to subscribe for derivative value plan. If you don't know how much is your brokerage, you can contact your customer service. Basically, customer service will help you to tell how much brokerage you will be charged in futures and options. And if you want to bring down the brokerage to rupees 20 per order, then you can subscribe to our derivative value plan, which is worth of 199 plus tax and annual charges. You can get rupees 20 per order as a brokerage in futures and option. Also get free access to Pro Terminal. One more big advantage of trading in derivatives is with HDFC Securities is zero interest on derivatives margin. Now, what exactly it is basically suppose you have a portfolio and you don't have cash to trade in derivatives market. That is, your bank account are short of funds and you don't have cash to trade in derivatives market, but you have a portfolio with you, equity portfolio. So you can pledge some of your shares from your portfolio, and against that, whatever margin you will be receiving by us, you can trade in derivatives market, that is in futures. You can buy futures, you can sell futures, you can also sell options. Also, you can avail that margin to trade in derivatives market without any interest cost. If you do the same thing, the competition to charge an interest in the range of 18%. So if you hold on to any of the FNO positions, if you take a margin through collateral of 1 lakh rupees and you hold on for 1 month at an 18% interest, will cost you 1,500 rupees as an interest cost. But here it won't cost you anything. There is no interest cost in it. So if you block 1 lakh rupees against the pledge margin which you have received against collateral, if you trade it into derivatives market, you can trade it without any interest cost. That is 0% interest cost. So there is a very good thing where basically you can take advantage of it, and you can avail full 100% margin to trade in futures options. You can also sell options. Many of the clients do like selling of options to earn premium and slow and steady income from by selling of options. But selling of options required good amount of margin. So because of that, they don't initiate selling options. But yeah, now if you have a portfolio, you can pledge your share, some of your shares or all of your shares from your portfolio. And against that, whatever margin is received, you can trade in futures and options market without any interest cost. So making this will help you to make your portfolio productive also, and also will save your cash margin also. So that's it from our end. Now we'll open this forum for question answer section. If anyone has any kind of questions regarding whatever we have covered so far, you can write it on the question answer panel on the right hand side of your screen. Till that time, I will just give you how to opt for derivative privilege. And if you have derivative privilege, and if you want rupees 20 per order as a brokerage, if you don't have that, you can also subscribe to our derivative value plan. So I'll just give you the link how to do that till the time you write in question and answer. So you can just Google derivative privilege in HDFC Securities. So there you will be able to get this link, which will help you to opt derivative privilege online through HDFC Securities. So you need to fill in all this detail. Once you click on proceed, you will be asked to upload any one of the documents like bank statement, 6 months latest bank statement, Form 16, or your last month's salary slip, or your income tax return. So any of the one documents you need to upload. And once you successfully upload the documents, after T+3 days, you will be informed that your derivative privilege is activated or rejected. And if it is activated, then you are good to go to trade in derivatives market through HDFC Securities platform. So here, this is the link. I will just copy and paste this link in the chat box so that each and everyone can receive this link. And if anyone doesn't have, they can opt for a derivative privilege to trade in derivatives market. And you also can subscribe to derivative value plan. if you want to opt for rupees 20 per order brokerage. So this is the derivatives value plan link. I will also give it to you in the chat box. You can find this. Both the links I have provided you in the chat box. Now let us go into the question answer section. Let us see. We have already got a good amount of questions. So here one more question is. So one question we have received by Mr. Arpit from HDFC Securities: what is bear put spread in futures and options trading market? So bear put spread is basically you can do this as an option trading strategy, where you can basically initiate the strategy if you want to minimize your loss, because as I made you understand, if you're a buyer of a put option, of course your risk is limited. But if you see on the different angle, your risk is fully with the capital which you have blocked. That is, your full capital will wipe off if in case your view goes wrong. But with this option trading strategy like bear put spread, where you need to buy one option and simultaneously to reduce the cost, you can sell one out of the money options so that your cost is reduced, and that will help you to minimize your loss and will help you to cut down your loss also. However, your loss is limited. In this case, your profit would also be limited because you have sold one lower put option to reduce your cost, and so your profit will also be limited and your loss will be limited. So it's a limited loss and limited profit strategy. So one more question is, so is loss limited or it can be unlimited for FNO also? Are the charges for Pro Terminal yearly or monthly? So Pro Terminal or the derivative value plan, which we have given you the link of, they all are yearly charges, and they are a yearly subscription tool. So one more questions by Mr. Mohammed Shadan Khan. आपके ऐप में लाइव प्रॉफिट एंड लॉस शो नहीं होता, बार और अपडेट करना पड़ता है. So we have already raised this feedback. Thank you for your feedback, sir. We have already raised it and will soon come out with the new app. We have been coming out with the new app, and in the second version of the new app, we will also come with live profit and loss, which you can get on your positions. So Mr. Swaminathan is asking, without derivative value plan, how much charge per order? So basically, depending upon the brokerage slab you have, maximum it will be charged rupees 100 per lot. You won't be charged more than that. But then too, it differs from different brokerage slab. Different client would be having it. So it's better to first check in which slab you come under. And then if you want to opt for rupees 20 per order, you can subscribe to derivative value plan, where we have already given you the link. So Mr. Mohammed is also again asking, 199 का प्लान कई बार लेना चाहा but कोई प्लान नहीं हुआ. So basically I need to make sure that आपका HDFC बैंक अकाउंट ही है. अगर आपका HDFC बैंक का ही अकाउंट है तो आप 199 का प्लान आप इजीली सब्सक्राइब कर सकते हो, बट आपका HDFC बैंक अकाउंट नहीं है तो ये सब्सक्राइब नहीं हो पाएगा. और दूसरा, आपके पास फ्री लेजर बैलेंस होना चाहिए, आपके पास कोई पोजीशंस नहीं होनी चाहिए. अगर आपके पास ई मार्जिन में पोजीशन है तो बहुत दिक्कत होगी, क्योंकि ई मार्जिन में क्या होता है, आपका बुक साइज रहता है और जो भी आप पैसा बैंक में रहता है वो बेसिकली ई मार्जिन में ब्लॉक हो जाता है. तो हम लोग 199 रुपीज पुल नहीं कर सकते आपके बैंक अकाउंट में. सो इसकी वजह से आपका रिजेक्शन आता रहेगा. अगर आपको तो भी दिक्कत आ रही है तो आप अपने आरएम को एक बार पूछ लीजिए, वो आपको सहायता कर देंगे उसको सब्सक्राइब करने में. So one more question by Mr. Pawan. Where can we start practicing before taking actual position in options? Is there any platform which provides such dummy positions for practice? So there is nothing as such where we can do a dummy position. You can do a paper trade. Suppose you can maintain a diary. Suppose you buy any kind of an option. Suppose you feel that I need to go long on these options, rather than going for a trade, you just jot it down in your diary and then just look after a couple of days or in an intraday how these options basically behaved, and based upon that, what kind of a profit and loss would you be able to make if you would have bought this option. So you can do you can maintain some diary, but as such there is nothing as such a dummy platform where you can execute the trade and you can monitor or practice it. So Mr. Mohammed is again asking, there is no margin, there is no position. So you can just get in touch with your respective RM. They will help you to opt for derivative value plan if you're finding it difficult. Amit Sharma is asking, will please explain zero interest on pledge margin? If I understand it, means we can use other positions as a pledge. So yeah, Amit Sharma, so what exactly it is? Now, suppose you have 50 lakhs of portfolio with you, and you want to basically trade in derivatives market, but you are short of funds in your bank account. So what you can do, you can pledge some of your shares from your portfolio. Suppose you pledge 5 lakhs of shares on your portfolio, and against that, after haircut, suppose you received 3,50,000 rupees, then that full 3,50,000 you can avail to trade in derivatives market without any interest cost. So suppose if you are an option seller, and if you sell options which requires good amount of margin, if you are an option seller, this is a very good tool where you take benefit of it, because option sellers require good amount of capital, and you don't have to block your capital from your bank account. You can do it by pledging the shares from your portfolio, and against that you will be able to use that margin. You can avail full 100% of the margin for to trade in that option selling. So I hope I made you understood. So is there any questions? We'll request everyone to please write it on the question answer section. Try to whatever doubt you have, try to clear all your doubts so that it becomes easier to understand. And because the derivatives are trading, basically if you trade in derivatives market, you should have a lot of clarity to trade in derivatives market about futures and options. So that will help you to trade smoothly into futures and options. Once you have the clarity about all your doubts which are there, then only you will be able to trade it in a very smooth manner. So request everyone, if there are any kind of doubts, please try to clarify it because it will help you for your trading. So we'll wait for more couple of minutes. If there are any questions, we'll answer, or else we will conclude this session. So one more question by Mr. Pawan. Call, sell and put, call slash sell and put slash buy will have option to exercise or square off the open position. So there are both the way you can do it, Mr. Pawan. Either you can exercise or you can square off your position also. So put buy here basically if you if you are buyer in put option. So in this case also you can exercise your option or you can square off your option. So there is nothing as such that you can compulsorily have to exercise or compulsorily have to square off. So I hope I have answered your questions because I didn't understood 100% what you were trying to explain me. But whatever I tried to learn from your questions, I tried to answer your question. Biju Nair is asking, so I pledge my existing shares, then any loss will be recovered from my demat, right? So yeah, if you are short of funds in your bank account, if there is any kind of a loss, first we will take the loss from your bank account. If you are short of funds from your bank account, then of course we will sell some of your shares from your demat to cover that losses. So Mr. Mustafa is asking, Pro Terminal doesn't have margin calculator. Can you provide? So you can check margin calculator over here only. So You can check in our HDFC Securities platform, where you don't have to log in to check margin calculator. It is in the pre-login page only. So once you go into hdfcsec.com, under products, under derivatives, there is a margin calculator. So you can check whatever margin you want. Basically, if you want to check how much margin will be blocked to enter any kind of a particular single leg or multi-leg strategy. So you can check from here. Suppose you want to check the margin for Nifty future. You can select Nifty and you can select the expiry you want, and we want to buy. So click on buy and click on add, and then click on submit. So you'll be able to see how much margin will be required to check to buy one lot of Nifty future. So here you will be able to check around 1 lakh of rupees of margin will be required. The same thing, you can check whatever how much margin required for this. If you want to do, you want simultaneously you want to buy put option. So what you can do, you can select Nifty. So you want to buy 17,500 put option. With Nifty future also you want to buy put option, so you need to select PE as a put. Select 17,500 and click on add. So now you will get the margin combined of futures and buying put option. So you will check, you will see 37,000, and also you need to add this 6,000 rupees with 37,000. So approximately 43,000 of margin will be required if you buy one lot of Nifty future and simultaneously buy 17,500 to hedge your position. So this is how you can check the margin. So I hope I have answered your question, Mr. Mustafa. So now no need to get margin calculator in Pro Terminal. You can check it in the pre-login page in our HDFC Securities website also. So if there are any kind of questions, we request everyone to please write it on the question section. One more question by Mr. Pankaj. If I buy call option for weekly expiry, then we have to wait for execution automatically or can square off anytime? You can square off anytime. Suppose you buy a weekly expiry contract which expires on 2nd March. So now we have a 2nd March weekly expiry contract, which is there on this Thursday. So if you buy it tomorrow, suppose tomorrow being a Tuesday, you can sell it in this next second also. You don't need to wait till 2nd of March. If you feel that I am not comfortable holding your position, or if you feel that I am comfortable with profit which I am getting it, you can sell in the next second or any next minute or next hour also. So you can basically, I need to basically I'm trying to convey that you can sell any point of time or square off any point of time whenever you want before the expiry. One more question, Mr. Ankit, is when this webinar will get repeat? I just joined very late due to poor connection. So, Mr. Ankit, we have our recordings in our YouTube channel, in our YouTube HDFC Securities channel. You can refer to that YouTube HDFC Securities channel. There are various recordings of all this webinar. You can refer to that, and will help you to understand futures and options. So it's a replica of this session only. You will be able to listen to that session. So it's a replica of that, and you can listen to it, and that will help you in understanding futures and options. So Mr. Pankaj Kumar is asking, if I forget to square off, then what will happen? So here, if for index options, you don't need to worry. Basically, there is nothing that will be and extra charge to you, or there is nothing as such penalty. But yeah, if you are having a stock options like Reliance, Tata Steel, and if it gets in the money, I made you understand how to check in the money options. If you refer to our option chain, the shaded part which is there in the option chain are called as in the money. And if you hold any of the strike price which comes under shaded part, that means it's an in the money options. And if you don't square off your positions on the expiry day, if it's in the money options, then you need to compulsorily either give delivery of the particular shares or take delivery of the shares. So you need to be careful. if you don't want to go under physical settlement obligation, then it is quite advisable that you square off your position before the expiry date, because if you don't square off and if it comes to physical settlement, then if you don't basically oblige to whatever physical settlement obligation is, then you tend to lose a lot of money, because there is a lot of penalty which is involved in it. So it's better to square off your position just before the expiry happens. You can square off on the expiry day also, before 3:30, before the market hours, so that you don't go for a physical settlement. One more question by Mr. Hariful Patak. Is there any brokerage plan for unlimited trade in FNO? No, as of now, we don't have this kind of a brokerage plan, Mr. Patak. Again, Mr. Mustafa is asking, can you give lecture on technical and fundamental analysis and patterns? So I'm a product manager for derivatives. So if you want whatever you want me to cover for derivatives part, I can do it. But technical and fundamental, there are various experts who come to our platform and gives us the session and discusses about various topics. And there are various webinars which happen. So you can just get in touch with your RM, or you can refer your mail whenever such kind of an webinars happen. You will be notified through your email ID. You can refer to it and you can attend this session. There are various sessions which happens. Okay, so I think there are no more questions. I'll wait for 1 more minute. If there are any questions, I will try to clarify the doubts if you have. I hope there are no questions. So we'll just conclude this session. I thank you all for attending this session. I hope this session would result in a very fruitful for you for FNO trading, and it would have provided a lot of insights of trading in futures and options. It was a basic part. Tomorrow we are also coming out with an option trading strategies. If you are interested in learning option trading strategies, you can attend tomorrow's session, which is scheduled at 11 o'clock. You will be notified with your email ID, or also you will be in our website whenever the session is there. On the same day, you will be able to know what all webinars are there, and you can register for that. So if you want to understand about option trading strategies, you can again come tomorrow and attend the session. It's a very good and interesting session. Basically, option trading strategy is a very smarter way to participate in any kind of market swings. So it will help you to make your futures and options trading at the next level. So I hope this session is also very useful to you all, and we'll surely meet again. Till that time, thank you and have a nice day.